Greetings. Here we are again talking about cash versus accrual accounting, and we're going to try to do it yet again to see if we can come to an understanding of how the interaction between accrual accounting and cash basis accounting works within a set of books of records, so that when you go out into the real accounting world, you can convert from cash to accrual or accrual to cash, which will be tools that will be used by you throughout your careers. And to try to do that, what I thought we would do today is first illustrate what actually is going on, and then I'm going to assign in an email to you on Canvas 2 problems from the text to try for Tuesday this week. If we can do those 2 problems, that'll be a good indication that you are getting it. This is an exercise that will, as I said, be used by you in your careers, primarily when it comes to the differences between income tax accounting and financial statement accounting. You're going to often have, more likely than not, financial statements on an accrual basis of accounting, accrual method, and you're going to want to report on a cash basis where it's allowed. Income tax law doesn't always allow cash basis, but when it is, it's a very powerful way to report your income for ways of tax cheating. I mean tax deferral that I'll explain in class, so it's not recorded. Okay. All right, with that said, let's take a look at what goes on. First, on this sort of football field approach here in the middle of the page where I have the words 2014 income accrual and expenses accrual. This is all a calendar year from one goal line to the next. If this is the beginning of the year here, like a timeline, we go over to here, and that's the end of the timeline for the calendar year. And what we try to do on an accrual basis method of accounting is bring into the books and records all the income that belongs to the year, because it's the earned income regardless of when it was collected. And we try to match the expenses to earn that income regardless of when it was paid. That's our accrual accounting theory in a nutshell. What was actually earned, we don't care about cash. What was the actual expenditures to earn that? Again, we don't care about cash. What happens in the real world, however, is that on the income side, we're often receiving cash in the year 2013 that belongs to 2014. That's what this means here. We got it in 2013, but it actually belonged to 2014, and vice versa. We often receive cash in 2015 that belongs in 2014 on a cash basis. Here, well, let's do it this way. Here, this is the easiest probably of the two to conceptualize. Money received in 2015 that was really income earned in 2014. Those monies here on an accrual basis would be recorded at this point in time as an accounts receivable. So the accrual basis to record that income here would take the income received over here and just record it as an accounts receivable. And then when it's received in cash in 2015, it would be a credit to accounts receivable, receipt of accounts receivable, in other words, reducing the accounts receivable. On the flip side, over here, income received in 2013 that really is part of the 2014 income. This represents income that's been prepaid, and we record that from an accrual standpoint at the balance sheet date right here as deferred income, income deferred. So it's not reported on an accrual basis back in 2013. It's deferred until, you guessed it, 2014. Result being that in 2014, we will journalize the money received here as being income in 2014. We'll reverse the deferral account and put it into income in 2014. That's what we do for accrual accounting, to get the right accounting, the right income into that year. On the expense side, we're trying to match, as I said before, the income, the expenses regarding that income, so that we can truly reflect the operational results of the entity. So that's great, and there is just like with the income accrual method, there's a lot of cash that actually happens within the 2014 year that belongs to 2014. There are a lot of cash items that actually happen in 2014. Down here it's illustrated a lot of cash items that are actually part of the expenses for 2014. I think I overdid it with this line at the bottom by stretching it out here. So let's just look at this line here. Well, let's do it this way. There are oftentimes cash items, go this way this time, paid in 2013 that belong to the accrual method expense category for 2014. Expenses paid in cash the prior year really belongs in the accrual method to 2014. And at the balance sheet date here, beginning of the year, we call these prepaid expenses. So they're not expensed back in 2013. They show up here as a prepaid. And in the 2014 year, what we do is we expense the prepaid. We release them from prepaid expenses, and they get expensed in the accrual method of accounting. Likewise, in 2015, sometimes we have expenses paid in 2015 that really belong to 2014 under an accrual method, so it matches against the accrual. Said again, sometimes we pay expenses out here that really belong in here under the accrual method. So these cash payments at the balance sheet date December 31 we'll call accounts payable. That's right, you guessed it. I heard you out there say it, so I'm glad you're following along. I can hear you, so be careful what you say. At any rate, that is in a nutshell what is actually happening from the accrual method of accounting inside here versus cash. Some cash comes in that matches perfectly to the calendar year for income. Some cash comes in that matches perfectly for the year of 2014 as an expense against that income. But much of the cash, not much, I shouldn't say much, but sometimes cash comes in early over here for income purposes or comes in late over here. Deferred income, accounts receivable. Sometimes cash expenditures are made here. Prepaid expenses, they should be recorded here as an expense. Sometimes the expense is paid in 2015. It's an accounts payable at the balance sheet date for 2014 so that it is brought in here into the accrual method. Let's just take an opposite approach just for 1 minute. Suppose we're reporting only on the cash method of accounting, and we're concerned about moving to accrual-based accounting. So on the cash method, as you can see here, we're just recording when the cash occurs, 2013, 2014, 2015. We don't pay attention to trying to match it to when it's earned and when the expense was incurred to earn that money. We don't try to match it to when the income was earned versus the expenses that were incurred to earn that money. It just reported based on when received. Received here, it's recorded as income. If it's paid here, it's reported as expense. Paid in 2014 is recorded as expense. Received in 2014, recorded as income. And likewise here, received in 2015 is 2015 income. Paid in 2015 is 2015 income. Okay, so that's the way we're reported on cash basis. So what you see is what we would try to do. As an example, suppose we have reported everything on a cash basis the way I just described, and we want to move to the accrual method. If we want to do that, then we have to look to see which 2013 expenditures were prepaid, if we were going to do an accrual method, for 2014 expenses, and set up the prepaid account. We would have to do the same thing over here for what income came in here that had otherwise been recorded as income on a cash basis, but now we're going to adjust the books to an accrual accounting. So here we want to set up the deferred. When we take out the income received here that was recorded as income on a cash basis and we move it to the deferred account, we're moving it out of the income here into a deferred account so it becomes income here when we release the deferred income into 2014, basically zeroing out the deferred income account at that point. When we take expenditures here that were expensed in 2013 on a cash basis, call them prepaid, setting them up here. That prepaid account takes them off of being considered an expense in 2013, and then we release it when we reverse the entry in 2014, taking those prepaid expenses and putting them into 2014. On the reverse side, again, moving from a cash basis back to accrual, cash was received here, reported as income in 2015, really belongs here. So when we set up the receivable here at this date, we're taking whatever cash was received here that belongs to 2014. By recording the receivable, the debits to accounts receivable, the credits to income, that gets the income into here and takes the income out of here when we reverse the entry in 2015. Reversing the entry pulls it out of 2015, leaving it back here where it belongs. And here, likewise, by the way, if you're not following all this, you can watch it again, take a look at the textbook, take a look at some, do a web search just for some. I'll send you actually a brief explanation that I did off the web search on accrual versus expense cash basis method, going back and forth. So hopefully a couple of these things will hit home. So here on the cash method, these expenses were recorded in 2015 as 2015 expenditures, but we said they really belong here to match against the income. So we set up an accounts payable. By pulling the accounts payable adjustment, we're basically bringing these expenses that were recorded here and expensed in 2015, we're bringing them back to this year, expensing them this year. With the reversing entry in 2015, we're taking them out of 2015 expenses and letting them stay back in here in 2014. All right, that's a brief explanation of what's going on, of how it looks from a timeline standpoint. It might be easier to conceptualize. Maybe it's not so easy to conceptualize. Again, I've been doing this in my sleep for the past 15 years after 20 years of struggling with it as you are. So don't feel too bad, but try the practice problems that I've assigned. Look at the reading material, the supplemental reading material that I've put on Canvas. Give it a shot, and we'll talk about it on Tuesday this week. I'll see you then. Thanks a lot.